So welcome everyone tonight. I'm very excited to be having this webinar tonight. It is going to be great. I'm excited to take notes on this one. Okay, so we are T&G Homes. We are a real estate agency and we specialize in investment real estate. We're joined tonight by one of our team leads, Tevin. Tevin is amazing to work with. She has a lot of experience and a lot of knowledge, and she is wonderful. She makes you feel very comfortable throughout the transaction, and she really takes care to make sure that you are getting what you need in your real estate goals. Gina, she's our other team lead, and she is also fantastic to work with. She's a real go-getter for her clients, and she uses a very practical approach so that you feel very confident in her abilities to get done the transaction, and she just makes everything go very smoothly. And then there's me, of course. I will work my hardest for you. I try my best to make sure that you get the property that you're looking for and that you are able to meet your goals and be able to achieve what you need to with your individual property. So our services, buying and selling. For a residential property, if you want to buy a home, of course, we can absolutely help you out with that. For selling, we do offer that, and we do a complimentary cleaning, photography, and staging so that your house can look its best so that you're able to get the best price for it. We have our specialization, which is our investment services. And we can help you find properties that will fit the needs that you have, as well as help you find the method that would best suit you for what you are looking for. We do home valuations, so we can look at the market and tell you about what your house could be worth based on the current trends that are happening. We do client education, like tonight, having you all here. We educate on real estate services as well as investment strategies, and we do our best to help everybody understand what they're doing and how to go about doing things. We are also really good friends with a lot of vendors in the area, and if you need someone, chances are we know someone. We know contractors, property managers, you name it, we can help you find someone. And lastly is our client communication, which we take very seriously. We are always there checking in and making sure that you've got what you need and that we've got everything that we need from you. And we try to touch base just to make sure that we are all on the right track. And one of the other things with our communication is it does not stop when you close on a house. You know, we continue to check up and answer questions and do our best to continue helping you, even though, you know, the house may have been bought. Another service we are offering is our short-term rental co-hosting. So if you have an Airbnb or you want an Airbnb, we can help you out with it. We can help it get designed and get it furnished. And then we can also help with the running of it. You know, the day-to-day, getting the cleaner scheduled, getting maintenance out, getting grass mowed, all those things. So you're able to keep your time and keep doing the things that you need to and not have to worry about those day-to-day things. So that's a little bit about us. And then if you want to contact us, here is our contact information. And if you have any questions, please feel free to reach out even after the webinar and everything. We can help you out. And then lastly, we have our master chat, which is a Facebook group so that you can join other like-minded people who are trying to invest in the area and also get hooked up with vendors. You can let us know what you might want for a future webinar. I would love some ideas. So without further ado, I will hand things over to Dave to do our webinar.
I'm a hard money lender. We do a lot of rehab financing, bridge lending, DSCR type loans for rental properties, ground up, multifamily, a little bit of everything. Without making this too much of an infomercial, I wanted to give you a little background. I've been investing in real estate for 29 years now. going on 30, sadly, and have been in the private lending space for 23 years. We've closed right about 4,300 loans, not including our DSCR product, because we don't track those. Our funding source primarily is a hedge fund that I manage that we use for most of our rehab, bridge, ground up construction, and things like that. We do sell off our DSCR loans like the rest of the industry. We take a little bit different approach. I don't know if any of you have ever talked to hard money lenders, but we're more of a, I hate to use the word partner, but in essence, we are. We take a very consultative approach. We're not the company you call and say, what's your rate and how fast can you close? There's just too many moving pieces to loans. So we like to dive in and understand what you're trying to do. We'll make our recommendations. It also helps us structure the loans to get you where you want to be at the end. So that, in a nutshell, is me. What I decided to do tonight, instead of doing the typical death by PowerPoint, as we're talking about numbers, I thought I'd put together a spreadsheet, which one of the couples on this phone will recognize because I actually started building it for them a while back. But my idea was we'll go through a spreadsheet, talk about the deal analysis from a rehab perspective, rehab to sell, as well as pre-qualifying it or basically pre-planning it if you're planning on doing more of a BRRRR model where you're going to hold it as a long-term rental. If you have questions, comments, anything that's not clear as we go through this, it would be okay with me if you unmute. What I started off with was more of a rehab to sell type of model. And I'm going to walk through, basically I took our database system that we have and converted it into a spreadsheet the best I could. But I want to walk through some figures and more or less lead you to the end. Some of these things are going to be very obvious. We're not going to spend a lot of time talking about them. Some of them not so much, because it involves private lending, it involves hard money lending, real investor lending, etc. So there are a lot of variables in this, and we won't be able to cover each and every one. But my hope tonight is to give you enough knowledge that you'll be comfortable running your own numbers and doing your preliminary due diligence on a deal before going under contract and before spending too much money and time on a project. So we all know that, I'm hoping we've all heard, you make your money in flipping and you make your money in all areas of real estate when you buy. Right? You have to buy at a certain discount. I took a deal that I did the other day for another gentleman and used those numbers out of my system just to test it. And we're going to play with that scenario first because it could be eye-opening. And then we could always tweak it. And if any of you have a live scenario that you're working on now, if you want to run the numbers, we could always put those in here later. But I'm going to assume that the property we're buying is a 211,000 ARV. Current value, that was based on what it was listed at 138. Doesn't necessarily mean that's what an appraiser is going to say. Repair costs of 45 and purchase price is 120. Here's the first thing. One of the things about running numbers, and I think I don't know if you do it, but I've done it. I try to lie to myself. I try to tell myself I can get something done in 4 months when I know it's going to be 7. I try to say that I can get rehab costs at $37.50 per square foot. So your analysis or your pre-qual on a deal is only going to be as good as the data you put in. So don't lie to yourself. The estimated time for a project timeline, the number of times I'm told that is 2 months from start to sale is amazing. The average loan, so we carry about 300 loans on our books, 300 to 350 at all time. Our average loan pays off between 9 and 10 months after the date of closing, to give you an idea. I have a contractor that we just closed on a deal, earlier this year. He's a general contractor. He has his own subs. He told me it was going to take a month, and I laughed at him. Fortunately, he didn't get mad. We're in month 5 right now, and they just finished the project. So if you've ever done a rehab, you know nothing goes as quickly as you think. So one of the key variables in your analysis is going to be timeline. If your contractors promise you that they'll get it done in a month, you might as well say 6, because it's going to take time to get the contractors in there, to get the property done, to get it listed. Now, again, this is purely from a sale model. To get it listed, to get a buyer that's willing to pay your price, although if rates drop, it will get a lot, I hope it gets a lot quicker. And then for them to arrange the closing. So allow time, because that will really affect your outcome. Here's the piece that, well, on the right side, we have our standard. I mean, these are all things that I am assuming most of you know about. Your monthly costs, taxes, insurance, utilities. I put a miscellaneous thing in all of my spreadsheets. And for example, if you have to mow grass for 6 months, are you going to do it, or are you going to pay somebody? If you have to shovel snow, depending on the part of the country you're in, are you going to pay somebody? I had a property in Missouri that I flipped, which was larger acreage. I paid $3,000 a month for yard mowing. So if you come into those kind of things, that's just a container that I like to use. I'd suggest you create that. Every time I think I know every single expense in a transaction, I get surprised. So it's easier to build it. Then we go down to like wholesale fees, sale title fees, all that type of stuff. You'd have to determine what some of those are by your area and by your partner. So your title company, they should be able to give you a cost for sale up front, basically a net sheet. Your realtors, anything like that would go on the right. The part that we seem to be in a quandary about over the last 6 or 7 years is this section here, financing costs. So lenders, quite honestly, we have made it very difficult for everybody to understand how we lend, including the lenders themselves. We have so many ratios that have come into the industry since institutional money has approached the space. One of which being a loan to cost ratio, and that's designed not to over leverage an asset. There's an LTV, loan to value ratio. You see some lenders out there saying they lend 90% of purchase price and 100% of rehab. Now, those are all conditional on each other, right? I went to an REI club here local the other night, and for those of you that know me, I'm not really a shy individual. And there was another lender there, and he said, "We lend 100%." And I said, "Cool, of what?" He said 100% of purchase price and 100% of rehab. And I knew the company he worked for. I said, "No, you're not. You're lying to everybody." And he goes, "Yes, we do." And I said, "Up to what LTV?" 70%. Okay, well, you don't. The world lends 100% up to 70%. It's nothing special. The ratio that's really, it seems most applicable at this point is now back to loan to value. Lenders will take into account their other ratios, but I haven't seen many deals lately where loan to cost and the 10% down model and all those really come into play. I have a 70% multiplier. I don't want to assume anybody knows anything. So in that scenario, 70% of after repair value would be 70% of your after repair value, giving you a loan amount of $147,700. Now, that's going to vary. What I forgot to say was your ARVs, all of your ratios are going to have a great deal to do with your credit score. So your target would be 680 and above. You can do it with lower credit scores, but your costs go up. And in some scenarios, your LTVs go down. So credit is something as an investor you really want to target, especially when we get to talking about the DSCR loans and non-QM. The vast majority of the aggregators out there, 680s will be your minimum target score. And the ones that will go a little bit lower charge a premium that almost make it impossible to cash flow a property. So if you've done 7 in the last 3 years, you're going to get much more favorable terms as if this was your first deal. Placing, in a lot of scenarios, depending on where you go, even placing a brand new investor in the market is tougher, and some lenders just won't touch it at all. So, for example, we, in our hedge fund, we can do new investors. That's not a challenge. However, I also have a guidance line with a family office. They will not allow me to place first-time investors on their line. So even internally to us, I have different models for different types of experience. And so you want to track that type of stuff. The other thing that will affect your ratio or your LTVs is going to be the property type. And what I'm talking about tonight specifically is 1 to 9 units. Once you crest into the double digits, things start changing, values change. The other side of that is rural versus suburbia or metro, or look at it from the standpoint of a primary or secondary market as opposed to a tertiary market. So if you get too far out, especially more important down here in this area, because you don't have to drive too far from Chattanooga to be in the country. That affects what type of loans are available and the options that you'll have available to come with that. But we're going to assume 70% tonight. We'll actually go up to 75% for well-experienced borrowers that are qualified. As a new investor, you're typically going to see in the market 60 to 65% ARV, unless you have compensating factors, good assets, things of that nature. Loan origination, I hope everybody knows what that is at this point, but it's the amount of money we charge to do a loan. Now, if you're working with a broker, you're going to have not only a lender origination, but also a broker origination. So you want to add all that in. And I just use 2%, which is what we typically charge on a loan. If you're brand new, it would be closer to 3 unless there's compensating factors, as well as interest rate. Right now, we're typically between 10.5 and 11.5, again, depending on your qualifications in the property. So that amount of information on just the loan is what's really going to drive your financial piece. If we ran those numbers, you can see that your repair costs and your purchase price are greater than your 70% of your after repair value. That delta, the 165 to 147,700, is what you'll commonly hear as a down payment. Although most people nowadays don't even talk about down payment. It's how much do I need at closing. The other costs outside of that down payment are going to be your closing costs. So whatever title company, and I'm sure Aubrey and Gina and Kevin and all them can help you with setting you up with the title company. And again, ask them for their fee sheet up front so you know the numbers to work on. Loan underwriting, we charge an underwriting fee and an appraisal. Now on the valuations, we will do a hybrid, an ABM. We will use ABM, or we'll use a hybrid, or we will use a full interior appraisal, depending on the asset, depending on what comps are around. It's pretty easy at full comps. If you were in Dalton, Georgia, I'm going to be looking for more of a full appraisal type thing. But we roll that in. You're right around $1,295, depending on the asset itself. If you get into multifamily, it's slightly more expensive. And then you have property insurance. Property insurance is one thing that over the last couple of years has skyrocketed, especially for rehab insurance, where you have theft and vandalism. So don't guess at that. Find an insurance agent, figure out what the cost would be on an average deal in the price point you're shopping for. So your total buy transaction costs, that and that delta between your purchase price and your loan amount comes down here to, on this scenario, $27,549. That's also with me saying I lend 100% at 70. It's really difficult to find a 70% deal all in, right? That's like the unicorn now, where you can buy it and rehab it for 70% of ARV. You used to be able to do it quite often. Right now, material costs are high and sellers still think their properties are worth way more than it is. If all those numbers held true, you'd have a whopping $12,000 profit with a 6.4% return on your investment. So if you were planning on fixing it up and selling it, the way you make this better, as I said at the very beginning, it all comes down to this number and this number. Now, rehab costs you really can't even control anymore. I mean, we used to have drywall hung for $5 a sheet, and that included like the mud, the tape, and the screws. Now you're $20 a sheet to hang drywall in most cases. And Gina could tell you, she just did a lot of drywall not too long ago. Where you're really driving it is your purchase price. If we change that number, you see here where your 147 is now greater than your rehab, your total cost. That's the 100% model. Any investor, any realtor, anybody will tell you it's really hard to get a worthwhile property for 100K that if you put 45 into it, it's going to be worth 211. Those numbers are just difficult. So the database system I use does all these calculations. I would imagine most of you have some type of a deal analysis software or spreadsheet or something you use. If you'd like a copy of this, I'd be happy to share it with you. The one thing I will say is it's macro driven, which means it's not a Google Doc. I know Google controls the world. However, if you upload it to Google, it could break the calculations. So, but if you'd like it, feel free to let me know. If we were to take that exact loan, that same carryover, the 211 and the 147,700 that we just discussed, and we wanted to go into, and this works for DSCR loans and non-QM, which is, it's very similar in nature to a DSCR, but they have more flexibility, and you are going to pay for that additional flexibility in interest rate and fees. However, sometimes it makes sense if you're a self-employed borrower or things like that, that you can't show assets or whatever the case may be. So if we were, typically what I hear is, well, I want to buy it, I'm going to fix it up, then I want to refi it, get all my cash back. So typically people are coming looking for cash out. On a standard DSCR loan, the max loan to value for cash out, assuming a 680 credit score or greater, is 75%. If we took that 211 times 75%, here's your loan amount. I ran it based on a 30-year fix. Now you can do ARMs. I'm not the guy that's ever going to suggest ARMs on a long-term rental. Think about the primary reason we have all the defaults and the pending commercial issues, where too many people did 5-year ARMs back when interest rates were 2, and now they're faced with 7.5 on commercial. So they're no longer cash flow. And as a result, the loans are going into default, which may give us an opportunity down the road to buy some commercial property. However, I always run everything at a 30-year fixed. You can always refi it if rates drop, but I don't want to be forced into a refi when the market's not favorable. I ran 2 different payments. You can do a P&I, principal and interest loan. Think of your basic home loan, right? You're paying principal and interest most of the time. Would put your payment at that, but you can also do an interest-only option. And again, there's a strategy for using interest-only. Typically short-term holds. If they're long-term holds, they may not work out too well. But the other is to help your property qualify at the right ratio to get favorable rates. You will notice there is typically a bump in interest rate between the 2 items. So you're paying a premium for the interest-only option. By the way, the interest rates I used here is what everybody's using as market rate right now. You see all the ads out there and every blast emailing if you even bother opening them. Those aren't real rates. Those are marketing rates. Very few people qualify at the base rate, and there's always adjustments to the rate, but you got to pick a spot. If you're running a DSCR model, I would typically say add a point to whatever you're seeing, 1% interest. That's worst case scenario typically. And again, planning, you want to be worst case to see if the model works. But interest only payment would be $890. So you can see your carrying cost is $110 $104 less by going the interest only option. So if you go to a bank, they use vacancy rates. So they'll discount your income on the property by whatever their standard vacancy belief is. And that'll range between 5 and 25%, depending on the asset. It also depends on the geographic area, whether it's a declining market or an increasing market. So you got a lot of towns to the Rust Belt that the market has been decreasing over the years, so they increase the vacancies. In DSCR, they don't use a vacancy factor. They do a ratio. They add up your monthly costs, and this is what's known as a partially loaded DSCR. So on your DSCR costs, you're just using property taxes, HOA, condo fees, if those are applicable, insurance costs, and principal and interest. Then they take your existing rent. If the property that you're doing was just flipped, you're probably going to have it rented. So you don't have to have it rented to refinance the loan. If you don't have a tenant in it, they're going to do a rental survey in the appraisal. Rental survey is where the appraiser, in their infinite wisdom, will determine what that property will rent for. I can tell you it's typically 10 to 20% less than what most market rents are in most markets. It's worth taking the extra month, again, going back to the timeline, taking the extra month and getting a tenant in. The other trick is also, if it's a month-to-month lease, they're going to use a rental survey. You always want to do a 12-month lease on the property. Now, you don't have to have that lease seasoned for any period of time. It's basically first month's rent and security deposit qualifies it as income. They will still do a market survey. However, in those scenarios, we provide the lease that's on the property, and 99% of the time, the appraiser is going to go ahead and use that amount on their rental survey. So in this scenario, $1,300 a month. Now, if this is a 1 to 9 unit, especially in multifamily, you can do other things. You have other sources of income, right? You have pet deposit, pet rent on all rental property. But in an apartment, you may have a garage parking fee, you may have laundry, you may have all these other ancillary sources of income. It's not used to qualify on the loan, however, would be part of your overall analysis of that rental property's potential. So you use the base rent, you divide your monthly income by your monthly expense to come up with debt service coverage ratio, which simply means your income is 104% of your expenses. In this scenario, it would not work for the typical loan. You can get DSCR loans down to 0.75, which means you're losing money every month. And for that privilege, you pay probably 2 to 3% higher in interest rate. The minimum you want to target is 1.05 if you're over 720 credit score, and 1.10 if you are at 680 or above. If you're below that, then a lot of things have to come into play. But in this scenario, it didn't work for him, but he also wasn't interested in making $54 a month in cash flow. Up here where I say maximize, if we just, instead of $1,300, made $1,310 a month in rent, your ratio now adjusted to where the loan qualifies. So if you're leasing a property, maximize every dollar you can on the lease. One of the things I always highly suggest is if they have a pet and you want to charge them a $25 pet rent, adjust the lease to be $1,325 or whatever it would be in this case. Build it all into one and define they're allowed one pet. If you break it out separately, it won't come to your qualification. You want to maximize every penny you can on your lease. So again, maximize your income. Now, let's go back. We talked about on the hard money loan, we talked about the standpoint of different ratios. They still have ratios. So it is possible that you will have a 1.05 ratio here. However, your loan amount won't quite get to that 75%. And so there are a lot of little tweaks, a lot of little turns in these loans. I always tell people, if you have a deal and you want to do your analysis, do it. Feel free to call me. The few of you that I have spoken to, I'm happy to walk you through the breakdown. I'll enter in our system and we can compare numbers to make sure that you've got everything covered. But that's your cash out model. So in that scenario, you end up getting a whopping $3,300.85 in cash out at 75% of value. Your initial down payment on the original loan, the hard money loan, rehab loan, was $27,300, and your hard costs, and what I mean by hard costs were the closing costs, your insurance, your carry costs, and your loan costs. To get this deal done, he would have had to invest $44,000 to get $54 in gross, and I want to point that out. That's gross monthly cash flow. Not really the best deal. I mean, you could keep your $44,000 in a money market right now and make about $200 a month. But there are some things you can do. If it's this scenario, the reason I used it was kind of a weird thing. You save $100 in your interest only payment, but you're trying to get all the cash out. If we look down where it says total cash investment at $44,000, I want to change this to just a rate and term, which means you're not trying to get any additional money out. Your interest rate, in theory, is going to drop about 0.5%. And I wish I'd have used a higher rate to make this real, because 6% is not the market right now. So for giving up that $3,300, you get a higher loan to value, because you're typically at an 80% on rate and term and on purchase. So these work if you're just buying it outright, not necessarily refinancing it. Due to that higher leverage, lower interest, your cash flow now just went up $168 a month. Gross. Still not ideal. However, in this scenario, it's hard to make this one an ideal thing. So sometimes it may not be worth getting cash out if there isn't a big enough lift in the property. Again, it all starts back at the beginning, and I know I'm a broken record on this. The difference between your purchase, your rehab, and that cancel, which is broken, and your after repair value, that is where everything happens. I also have another gentleman that I just did this deal for. I'm going to plug in some of his numbers. We're not going to fiddle with the taxes and that type of stuff because it's not worth it. Here he still had to bring money, the difference between the 70% and the after the 70% of the ARV. However, it wouldn't have been a great flip, but it was a good rental. Here in Chattanooga, he actually has both units rented right now. It's a duplex for $3,400 a month. If you look at that delta in what he paid and what his rehab was, what his monthly cash flow is, just off of a rate and term loan to 80%. He's got $56,000 in to a property that, I mean, this is gross. It's not net. So you still have to build in all your other expenses, but a $24,000 gross rent annually for a $56,000 investment. Now, the other thing you can do is if you're going to carry a property for 5 years and you're sure of it, you're going to sell it in 5 years, whatever the reason is, that interest only option up here, if we change our monthly debt service on the ratio to just the interest only option, it jumps up another $180 a month in cash flow. My logic for this is twofold. One, it could help you qualify for the loan if your ratio, I mean, this loan, he's got 2.64 ratio on the loan. That's a rock star deal. But if you needed to lower your monthly expenses to get to that 1.5 or 1.10, sometimes just converting the interest only, even though you're paying a higher interest rate, will reduce your monthly expenses and put your ratio at a point in which you qualify. There are some different strategies you could use. The drawback is it's not a good call on a property you're going to hold for 20 years. On the interest only options, they're typically for 5 years or 10 years that you get to pay interest only period payments. After that, then the loan amortizes on a 25 or 30 or 25 or 20 year amortization. So your payment goes up considerably. So if there is a possibility you want to hold it that longer than the interest only period, you definitely will want to look at refinancing somewhere in that range before it does mature. A couple of things that are, well, actually pretty close. You still have to have assets. If you're buying a turnkey property and going into a DSCR loan, you have to have the money, be able to prove you have the money for the down payment. The reserves, it's going to depend on the aggregator. You can do 3, 6, or 9 month reserves. Shockingly, the 9-month reserve lender is a lot cheaper than the 3-month reserve lender. What I mean by cheaper is your interest rates are better. Again, the better you're qualified, the more you can document, the better your loan, which all drives this bottom number. And that's really what you're shooting for. Because even on this deal, if you take into property management, he's going to self-manage. But if you added property management, tenant turns, everything else on this property, and he's still going to be probably in the $1,500 a month cash flow on a single property that he paid $200 for. That's pretty solid. I didn't continue with a full analysis for your rentals. Again, you do have ancillary costs. You have vacancy costs. I mean, if you're only making a couple $100 a month, and your cost is $1,000 and it goes vacant for 2 months, it's wiped out your cash flow for the full year. You have tenant turn. A tenant turn could be paint carpet. It could just be simple cleaning. Typically on my rentals, I end up spending between $3,000 and $5,000 on a term every time a tenant leaves to get care of the property. But again, it's every once in a while. You've got other just miscellaneous costs, which you guys will need to build in. I wanted to try to make this as short as possible, and I'm running out of time, so I will move forward. $279 may dwindle if you're paying a manager down to about $125 a month, and that's just kind of a guesstimate on my part. To make $125 a month for $56,000 is a really bad idea. I will talk to everybody out of that. Again, you can make more in your money market, and you don't take on the risk. But I had a gentleman the other day said, and I think he was going to make like $175 a month rent. And he's a newer individual to investing. He's like, is that really wealth building? And I said, absolutely not. You're only going to make so much in rental income. I mean, if you made $300 a month, how many of these do you have to have in order to be able to retire well? Right? I mean, a couple hundred, the liability and headaches associated with a couple hundred rentals. Yeah, it isn't worth it. Where your real profit and wealth comes from in real estate, so 56,563, is the fact that you have compounding growth on a leveraged asset. We assume that's still that original $211,000 value as today, and you're holding over a period of time. I have average appreciation for the area in red. In Chattanooga in the last few years, I mean, it's probably went up 30% since the pandemic. You can say that about a lot of markets. I know in Boulder, Colorado, we jumped 25% during the pandemic. That's not an average appreciation. That's oh my God, I got lucky appreciation, right? I'm old enough in this industry. I also got to see the bubble where we dropped 30% in value. So don't try to pick the highs and lows. It's easy enough to find out what the average appreciation for the market is over a long running period. And one of the gentlemen I know here, Jeff Holtz, he looked up the data and it was just under 5% for this area. for the historical average of appreciation. If you did that 5% over 10 years, your 211,000 jumps to a value of 343. That's $132,000 in appreciation. That's where wealth in real estate's created. I use 10 years because I'm one of those guys. I don't like to hold real estate longer than 10 years on average. I like to flip it at that point, mainly because it's time for me to rehab the property again, and I'm too cheap. If you were to hold this property for 30 years, first of all, if that's your idea, hire an accountant and tell them that, because they'll talk you out of it. But that $211,000 property at 5% compounding growth over 30 years is now worth $911,000. You have 5 or 6 of those properties, you're good, right? I mean, you're going to complain about taxes, but that's a good problem to have. Likewise, where I said earlier, I wouldn't put that $56,000 in to make $200 a month because I could make more. That $56,000 in that account that I would make more today on would only be worth $244,000 in 30 years compared to that 911. So the compounding effect is probably the most profitable part of real estate as far as the appreciation goes. It's one of the few things that you can call an appreciating asset other than stocks, bonds, that kind of stuff, but that's nerve-wracking. Real estate's nerve-wracking as well. But you also can get tax-free income. Now, one of the problems with it is you're using what's called depreciation on your property to offset your rental income taxes. There is a secret that most investors forget about is when you sell it or on the 30th year, the IRS wants that money back. So you're deferring taxes through depreciation. It's not truly tax-free. Hopefully all of this helped. That's all I have for this evening, Aubrey. If you want to see if anybody has any questions, I'm happy. What I would say is that if you want to get a hold of me, I'm going to put up my contact data here. Well, if I can figure it out, I'm going to put up my contact data. I'm happy to go through this. I'm not really a high pressure kind of guy. I do like to work with my borrowers and try to help them as much as possible, just like Aubrey and the team. Our whole goal, I think we have a mutual understanding. Our whole goal is not to put somebody in a deal that's bad, because while we may get a commission check for that particular deal, it's not enough money. And my strategy has always been, I don't care if I do one loan with somebody, I want to do 30. And for me to do 30, I've got to do everything in my power to help you through the process. So if you want to give me a call and walk through your deal, I'm happy to help you. Aubrey, thank you. Everybody, thank you. I hope you learned something. But Aubrey, it's all yours.
Thank you so much, Dave. That was wonderful. Yeah. Does anybody have any questions?
I don't have any questions, but I just wanted to say really quickly, Dave, thank you so much for this presentation. I learned quite a bit, and I'll just quick little shout out. I have worked with Dave myself as an investor, and he is fantastic to work with. He means it when he says he'll go over your numbers with you. He did with me. He actually walked a property with me and gave me his feedback, and it was really funny because he was like, I think you're going to spend X amount on this property, and I was like, no, I'm not. Like, no way. And I'm almost actually done with this current property, and he almost nailed it on the head. I still think I'm not going to hopefully get what the number he said, but there was quite a bit of a spread between what I thought. Luckily, the number still worked out, but I think, like he said, wants to give you the loan, but he knows his stuff. And if you want to get like a second opinion, absolutely call him, and he will totally help you out.
Well, thank you for that.
Well, if no one has any other questions, then I guess we'll go ahead and wrap up.
Oh, Aubrey, thank you. And to the team, thank you. If you need anything, yell. Otherwise, we'll talk to you at some point, I'm sure, here in the near future.
All right. We'll see you. Thanks.
Have a good night.